Hello. In the second lecture, The Perception Bias, we discussed together how the behavioral finance could help us understand some of the behavior while we're taking decision that we can't understand under the predicates of the conventional finance. In the second lecture, we concentrated on the perception bias, and that is that the bias we tend to make when we perceive the information on which we base our decisions. That is then a bias that happens even before we take our decision. The reason of the perceptional bias are multiple. They could be related to one or more of reasons. The most known reasons for that could be either our selective perception, and that is that we see usually what we want to see based on our own culture, our own experience, our own knowledge, our own situation, or because of the overload of the informations. That is that nowadays we have a multitude of information, the volume, the variety, the velocity where we get this information makes it impossible to us to cognitively be able to process the information in a reasonable, considerable time to take the decision. And that is why these bias happen, because we try in a way or another to limit the possibility of the options. And that is what we call rule of thumb, and that is how we overcome the load of information. And the selective bias, where is a bias that happens because we already have our experience, our preference, our understanding, and then we tend to see the things in this perspective. So let's try to check the first question that could help us identify different possible bias that we studied in the second lecture. So we have certain situations that we are going to try to define the possible bias and explain the behavior according to this. In this first situation, when we present people as a possibility of 90% probability that the population would be saved using a new medicine that we are introducing to the market, over the possibility of 10% of population that people will die using this medicine, people will find that the first one has a better outcome. Although that both of these situations has the same identical possibilities. So they have the same results. Why so? Why do people then choose, or they find the first option as more comfortable or more acceptable? It is, as we said, both of them are identical pair of gambles, identical pair of probabilities. But one of them is focusing on the positive impact of the outcome, and the second one is focusing on the negative impact. We've seen in our lecture that people prefer the positive impact due to the framing effect. They see, in this case, the situation as a gain or a loss message. For them, the 90% would help them save the population rather than 10% not helping people. And that is why this could be due to framing bias. It is when we present for people the same ideas, the same information, the same probability in two different situations in order to nudge them or make them take one of them. In the second situation, a high volume of purchase of certain attention-grabbing stocks among thousands of stocks in the market, although that those stocks did not beat the market or never earn abnormal profits. That is, that people then in the situation, they are concentrating their investment choices or limiting their investment choices to certain amount of stocks, a group of stocks that are attention grabbing. That is, for instance, they've been all the time in the news, or they are in a very lucrative industry. People usually do this because this helps them to limit the effort and the time they need in order to take the decision due to the overload of information. So they would limit their search to these only attention-grabbing ones because it's easier for them to find the information. The information for them is available. So they are here in this situation making the availability bias. Because in this way, this investment decision is being limited to the available retrievable information. The availability bias, as we've seen as well in our lecture, could be due to different reasons, either because of the retrievability of the information. Some information are easier to be remembered. For instance, you would remember about certain stocks that are very known in the market, or because you know that it's the category in which the stocks is normally having a very good return or is really well known to you. In our situation here, people may have based their selection on the retrievable information that is about the attention-grabbing stocks, that they were maybe all the time in the news, or they are the stocks of very famous companies, for instance. And then situation C, a positive announcement about a stock in the market may be considered by optimistic traders but ignored by pessimistic ones. So in this situation, we have the very same piece of information. It hasn't been presented in different ways. We are having the same way, the same format of the information, but it's being received and perceived in the market in different way. Optimistic people have seen this as a positive announcement, whereas the pessimistic people have ignored the situation or the announcement. That means that these pessimistic people ignored this information, maybe because it doesn't uphold their prior belief, whereas the optimistic investors have seen this as a confirmation of their optimistic beliefs. And this is what we call the confirmation bias. It's when the investor then seeks the information that supports their belief or to ignore ones that they don't. This may lead them anyways to poor investment decisions. So in this case, for instance, for the pessimistic agents, they could be neglecting a very profitable investment opportunity. And for the optimistic ones, they may be giving more credit to this positive announcement than what is it. This confirmation bias could be caused because then of that we neglected a fact or we interpreted the information in order to support our own beliefs, or because anyways we ignore the situation or information because it challenges or it doesn't confirm our own established opinion. In exercise 2, we're going to discuss the framing bias. In the first part of this exercise, we are asked to briefly explain the concept of framing. We've just discussed a situation where framing is presented when two options or two uh, identical pair of gambles or two identical pair of outcomes have the same probabilities, but they are presented in different ways. So, in order to influence our likings or preferences towards some decision, so the framing bias is an effect that is a cognitive bias where people decide on option based on whether the options are presented for them in a positive or in a negative way. Uh, People then, we said that they tend to avoid risk when a positive frame is presented to them, but they seek risks in a way that the negative frame is presented. And that is what we discussed in our lecture when we talked about the situation of framing options of taking the corona vaccination or not. Um, in this case, in the case of framing, the loss is then more significant than equivalent gain, but the sure gain is favored over a probabilistic gain. One of the dangers of this situation of the framing effect is that people are often provided with options that within the same meaning but with two frames. That means that we are limiting how people perceive the information only to two options, and we are trying to nudge them towards just one. And this is why sometimes some people would prefer to take the stock that's presented to them, for instance, as a stock that would pay itself after 5 years over a stock that have 20% return, which is the same. But however, people may tend to choose the first one because the frame was positive and certain. In part B of the question, how does asking for prices versus asking for returns affect stock market forecasts? What does that mean? When we ask people to expect the price of a stock, would that be for them a different estimation or a different way to process the estimation other than when they are asked to expect? Stop, sorry, pause. In the second part of the exercise, then we have this question. How does asking for prices versus asking for returns affect stock market forecasts? So, prices and returns are kind of both of them are performance measures. They are alternatives of the same thing. So, according to the classical finance theory, the rational people should get the same piece of information, should perceive these two pieces of information and expect upon them in the same way. However, if that's true, if the way we are presenting the information or asking about it won't change, then why do different information or sources, different financial information sources present to us the information in different shapes and different formats? So if you go to the websites that provide to us financial information or any financial service provider or advisor, each one will have their own presentation. Some of them, they present to us the expected prices or the charts of the last 10 years of price development, and some of them would tend to give us only the return charts of some kind of stocks, whereas they will give us the price line for other kind of stocks. So in order to understand if there's any difference in the way we present the information or asking or asked for it. We have a very interesting paper. It's a recent one, and that's why as well it's very interesting because it proves us again that behavioral finance is always relevant in this situation. Stop, Pause. In the second part of the exercise, how does asking for prices versus asking for returns affect stock market forecasts? Prices and returns are performance measures. They are alternatives of the same thing. So, according to the classical finance, there should be no difference. Agents should receive the information and perceive it, and in the same way, whether it's we are asking for price or stock, because they are identical alternatives of the performance measure of a stock. However, if that's true, if there's no difference, then there's a very important question here. Why do we have in the market different possible sources of financial information with different formats of prices and returns? Then why does, for instance, Yahoo Finance have different way of presenting the performance of stocks other than Thomson Reuters or other kind of studies that are trying to expect the prices of stocks? This is what Glasser, Eliwa, and Wepper tried to understand in their paper in 2019. So this is a very interesting article because as well it's recent. So it's a new confirmation for us that behavioral finance could explain to us a lot of what's happening in the financial market. So the main objective of their paper was to understand what would influence this choice between prices, using prices to expect or to forecast the stock market performance other than the returns, for instance. So as we just said, prices and returns are alternative way to present information, and they should be the same, they should be used in the same way. However, in their paper then, they ask themselves two questions. The first question is asking for subjective price level expectations is identical to asking for subjective return expectation. And the second question are expectations based on historical price level charts, identical to expectations based on historical return charts. So basically, they were trying to understand that if we were asked to expect the price of a stock on our own estimation, would we estimate the performance of this stock in the same way if we were asked about the expected return? Would we have the same way of evaluating this performance? And they wanted even to understand how do we perceive the information while we're doing our search, trying to understand the performance of the stock. That means if I see my information or I perceive it based on a price line of the price development in the last 10 years, would I perceive it differently than when I see the bar chart of returns? So once again, the question is the way I ask my question in the market would influence the expectation of people? Is the way I present the information in the market would as well influence this decision? This is what they were trying to understand in this paper. So in order to answer the questions, questions, they designed 3 experiments. In the first experiment, they asked students to expect or to forecast the return or the price of artificial assets based on information they fed them, which is either the charts of historical price development or either the charts of the historical return development over 1 year for the given assets. They promised them fixed remuneration for euros for each expectation or each forecast. In this, that was the baseline experiment. Then they wanted to check the robustness and the validity of their outcomes. So they designed experiment 2. In experiment 2, they asked students again, 169 students in the lab artificial situation, then in the lab of the university, feeding them the same kind of information. This time they just changed one variable, which is the remuneration. So they promised the students of 21 euros when their forecast is within the interval of 90% of accuracy. Otherwise, they will get 6 euros. In this way, they could understand of whether the remuneration plays a role in our expectations. However, then, in experiment 3, they had a real life experiment. In this experiment, they asked 212 professionals and people who do a living out of their expectations. They are financial advisors or people who are CFOs, people who are faced every day with decisions to allocate their assets in portfolios. And they didn't give them any information because they had access to real life situation. They have lots of resources, and anyways, this is their job is to get this information and evaluate them. They just ask them to try to forecast the DAX 30 in the coming month. So, how did they design the experiments? In the first 2 experiments, as we had artificial assets, they had 2 stimulus. So, some students showed them, they've been showed the first stimulus, which is the price development over a year with 12 sequence, that means 12 months. And they ask part of these students who saw this stimulus, the price stimulus, to expect the price in 1 month. And the second part of them, they ask them to forecast the return over next month. Whereas in the second group of people, of students, they showed them the stimulus return, and they showed them this sample, this chart that shows us the returns development within a year with 12 sequence as well, 12 months, and asked them either to forecast the price based on this return chart for the next month, or as well to forecast the return in the over the next months, but as well based on this stimulus. So they just wanted to understand if the format would change anything in their forecast, or the question would change anything in their expectations. However, for the third experiment, as we said, they are professional advisors, so they didn't show them anything. They just asked them in 12 sequence within the frame of about 3 years, to every time to either expect or forecast the level of DAX index in the upcoming month, or they ask them to decide or to try to expect the return of DAX. Again, in all of these tasks that's been designed, they are asking of the same thing. measuring the performance of the stocks, or in this case, in the third experience, of the DAX itself. However, the way the question has been presented and the way that the information has been fed is different. So what were the results? For the first two experiments, the results were that whenever we were asking for returns, we had more optimism. And when we showed people charts, they were more pessimistic. Return charts. So they were more pessimistic. That means that people tend to get higher expectation when they are expecting for return, but when we show them the return, they would expect really that the returns or the price would develop itself in more pessimistic way. So that is because maybe they are not professional. So what did the professional result show us? The professional results show us that in the same way, professional people had or were even more optimistic. And however, when we asked them for return, they were always very optimistic. That means the professional themselves were subject to the framing bias in this way. So if you go back to the questions of this study, so the authors wanted to understand whether the way we ask people to expect about the stock or the way that we ask them to evaluate the performance of stock would influence their own expectation. The answer, yes, that means they won't predict the price, the subjective prices, and the return price expectation or subjective return expectation identically. When we ask them to forecast return as opposed to prices, results are higher in expectations. And our expectations based on historical price level charts identical to expectation based on the historical return charts? Again, no. Showing subjects return charts rather than price charts results in lower expectation. It means that the way that we present the information itself, the way that we make people or feed them the information, the stimulus, the way that they perceive this information is not identical, although they are same alternatives for the performance measurement of a stock. So why is this study important? The study is important because it implies different ideas. The first one is regarding the format design. That is how we feed people the information, which, for instance, in financial market, we could be able to alter people behavior towards certain choices. For instance, let's suppose that we always, for instance, present the historical performance or the expectation of the steel industry, for instance, based on the price lines, whereas we always present people the information about the pharmaceutical stocks industry performance. With the return charts, we will be maybe able to alter their behavior towards the second one. That is why this is really in some way crucial. It is as well crucial and more important, more relevant than ever, because nowadays the financial advisors, the financial service providers are available. They are everywhere. We seek information out of them, and their decisions then, the way that they communicate their information to us, their advices to us, may be able, or the way they formulate their expectations or their questions to us may alter our decision. It is even nowadays the real question ethically that we are going into the era where we are going to use more and more artificial intelligence service providers. For instance, let's suppose we have an software on our mobile that helps us to take financial decisions. Suppose this is supposedly an IA software, but it would communicate with us with numbers and figures. So, would the figures and the let's say the charts or the expectation, the way they are presented through this AI software, be able to alter our decision? This is a big question nowadays. That's why, as well, the study is relevant for regulating the market, the information in the financial market. Till now, we've always we know that there are certain kind of information that are standardized. That means that for certain kinds of information and financial communication, companies have standards that they need to comply to. However, all information aren't regulated, and here is always the question: how far should we regulate the way we present information in the market? In our third exercise, we are going to discuss the base rate fallacy. The base rate neglect or fallacy in behavioral finance is the tendency for people to earnestly judge the likelihood of a situation without taking in consideration the whole relevant information. For instance, it is for when investors in the market decide to invest in a stock just only upon a new piece of information regarding this stock without taking in consideration other relevant information. In this case, then, the investors would limit their research or their decision taking upon the available information. That is why most of the time we say that in behavioral finance, the base rate neglect is most likely to be a consequence or really related to the availability bias. Let's try to see through exercise 3 what does that mean. In exercise 3, we have a situation of a city in which we have 1 million inhabitants. Let there be 100 tourists and 999,900 that are non-tourists. That gives us a base rate probability of a randomly selected inhabitant of the city being a tourist of just 1%. However, as well, the base rate probability of the same inhabitant being a non-tourist is 99.99%. So, in attempt to catch the terrorists, the city installs them an alarm system with a surveillance camera and automatic facial recognition software. This software, however, has two failure rates of 1%. The first failure is the false negative failure, which is if the camera scans a terrorist, that means the bell will ring 99% of the times. However, it will fail to ring 1% of the times. The second failure is the false positive rate, where the camera, if the camera scans a non-terrorist, then a bell will not ring 99% of the times. However, there is 1% possibility that the bell will ring, although that this person is a non-terrorist. So, suppose that an inhabitant triggered the bell. The camera scanned them, this person, and then the bell rang. So, when we are going, if we are going to make the base rate neglect fallacy, we will come to that conclusion that there is a 99% possibility of this person being a terrorist. It is a possible reasoning, but it's wrong. Let's see why. So, what is our issue? So we said that we have a population of people of 1 million person. We have, of which 100 inhabitants that are terrorists, and the rest that are 999,900 inhabitants that are non-terrorists. So then we decide to install an alarm system with a bell. The system, however, either is gonna ring 99% of the times when it scans a terrorist, or 1% of the time it will fail when it scans the terrorist, or either it's going to scan a non-terrorist, an inhabitant that is non-terrorist, and then there's 99% of the times when it scans this person, it won't ring, but in 1% of the situations, it will ring. So the Bayes rate fallacy means that we are inferring that there's a 99 possibility that a detected person, when it rings, it's 99% is a terrorist. So let's check this together. So why is this assumption that there's a 99% of probability that the detected person is a terrorist? And that is a Bayes rate fallacy. First, it seems logic, because we've said that the camera will, when it sees a terrorist, there's a 99% probability that person would to catch this terrorist, or to scan it and identify it. However, this is an example of incorrect intuitive reasoning, because it fails to take into account the error rate of the software detection. What does that mean? It means in this situation that we had a cognitive bias in which the information about the rate of occurrence of some trait in the population, in this case the Bayes rate information, the percentage of people who are terrorists and the percentage of people who are non-terrorists, is ignored or not given the appropriate weight. So why does this fallacy arise? It arises from confusing the nature of two different failure rates. The failure that the probability to fail to ring given that the inhabitant is a terrorist, and the probability that the inhabitant is a non-terrorist given that the bell rings. How is that? So let's calculate the probability of the person being a terrorist when the bell rings. Supposedly, let's suppose that we are going to scan the whole population. So again, we have 1 million inhabitants, of which we have 999 inhabitants that are not terrorists and 100 that are terrorists. If we are going to scan the whole population, that would give us that when we scan the non-terrorist inhabitants, there is a possible 99% of the times the camera won't or the software won't trigger the bell, it won't ring. However, with a percentage of probability of 1% of positive false positive rate, we will have then the bell ringing 9,999 times, although that those inhabitants are non-terrorists. In the same way, if we scan this whole population, then in the case that we have the terrorists, every time a terrorist is scanned, we will be able to scan 99 terrorists, but we will fail to identify just one terrorist. So that is in this way that we flagged a number of people, that is the 99 person who are terrorists, we flagged them, but as well we flagged 9,999 per inhabitants as terrorists, although they are not, which gives us that we have the number of people being terrorist and being scanned is 99 in 10,098. So this is a probability of less than 1%. This means that there's more than 99% probability of those flagged are not terrorists. So let's try again to explain the situation by using the probability of the probability of generally the bell ringing and the person being a terrorist. So the bell will ring in two situations. The bell rings either because it's a false positive, and this is a non-terrorist, and this is the possibility of 1%, or the bell will ring because that is a terrorist, and that is the probability of 99%. So the probability of the bell ringing and having a terrorist is the probability of the our favorable, in this case, event, which is the terrorist, divided by the whole probability of the outcome, which means that the probability of that person being terrorist is the probability of the bell ringing and that person is really a terrorist divided by the probability that the bell would ring, although it's a non-terrorist, plus the probability of that bell being ringing and that person not being a terrorist. We know the numbers already, that it's 99% divided on 1% plus 99%, and that would give us again the same number. It's less than 1%, which means that in this situation we are 99% wrong and just less than 1% right. So it's scanning the non-terrorist, or it's when the bell rings, there's a 99% chance that it's not a terrorist. To understand that, again, let's imagine that we have the same alarm system in another city that has a 1 million population of inhabitants. However, in this city, there are no terrorists. Everybody are non-terrorists. Then that means the bell will ring in two situations. Either we have a false positive, that is a bell rang and scanned wrongly an inhabitant that a non-terrorist, or the probability of the bell ringing having a terrorist. However, in the city there are no terrorists. That means that the probability here is 0. And that gives us that the probability of bell ringing and that person being a terrorist is 0, which means the alarm system in this way will give us 100% failure. Every time you are scanning somebody, you are flagging them wrongly as a terrorist. As we see here, then this is the population. We scan the whole population of 1 million people. In this population, we have no terrorists. Then we flagged everybody wrongly. Everybody that has been flagged was flagged wrongly in this situation. Why is it really critical? It is so misleading in this situation because in this example, there are really more non-terrorists. A base rate is really higher than the terrorists themselves. The number of false positive, the non-terrorist scanned as a terrorist, is so much larger than the true positive terrorist. This situation we could see in as well in financial market or in daily life. For instance, investing in investment. An investor falling for the base rate fallacy would be giving more importance to the readily available new information and discard the information regarding the past performance. And that's this whole picture, the past performance is being ignored. That is what we call then the base rate fallacy. Thanks a lot for your attention.